Greetings, and welcome back to the podcast. This episode, we are joined by Mr. Steve Larke, Director at Topaz Royalty, Headwater Exploration, and Vermilion Energy, three TSX-listed energy companies with market caps of approximately $3 billion, $2 billion, and $3 billion respectively. Mr. Larke's previous roles include operating partner and advisory board member with Azimuth Capital Management, an energy-focused private equity fund based in Calgary, Alberta, Canada. Prior to joining Azimuth Capital, Mr. Larke was managing director and executive committee member with Calgary-based Peters Co from 2005 until 2015, and prior to that was vice president and director with TD Newcrest from 1997 until 2005. Both at Peters Co and TD Newcrest, Mr. Larke received leading rankings in the Brennan Wood International Survey of Institutional Investors. Mr. Larke has a Bachelor of Commerce degree with distinction from the University of Calgary and has earned his CFA designation and Institute of Corporate Directors designation. Among other things, we sat down and discussed the Jevons paradox for efficiency, inflation, and why global energy demand is up 35%. Enjoy. This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. This podcast is sponsored by headracingcanada.com. In partnership with four-time Olympian Manny Osborne-Parody, headracingcanada.com is offering European factory performance ski gear from its online storefront by passing brick-and-mortar savings on to customers. Check out headracingcanada.com for more info on the 2024 collection and get your high-performance ski gear for the upcoming season. Good morning, Mr. Steve Larke. Thank you very much for doing this again.
Good morning. Happy to be back.
I've been circling back, like I mentioned, on a few of the fan favorites as of late, and also some of my personal favorites. So this is great.
Thanks. It's good to see you again for sure.
You are on the board of several high quality companies, which gives your perspective a lot of value that I know the audience really appreciates. So, and I'm also not late this time.
In fact, I was the one who was a little late. So there we go. It balances out.
This is also episode 150.
Ring the bell.
Who would have thought?
Congrats. Crazy, that's great.
Crazy podcast would get to where we are now. But I thought for the purposes of today, to give the conversation a bit of structure, we could get an update on a few of the topics from last time that we spoke about, and then maybe your thoughts on current events in energy.
That sounds great. Yeah. Ask whatever you like. Unscripted.
Exactly. The best people don't like to script these things.
That's right. Yeah.
First one I guess we could get into was your article from the Calgary Herald, March 2023, if I'm correct.
Yes, that is correct. Yep.
The idea being, to start broad before we get into it, where energy is headed, and the combined efficiency and demand of energy is increasing overall demand rather than reducing it.
Yeah. Okay. So to give context, somebody asked me to write this article. It was titled, "There is no silver bullet." It got published. Unfortunately, the editors took the conclusion out, okay. Which, they don't ask you that sort of thing. They just choose what to publish. And the real conclusion surrounded the fact that the energy transition is going to be very messy, and much more so than perhaps is advertised. And we really do, in the context of Canada, need to support a very good and strong industry. And I know there's energy guy bias there, but I can walk you through some of the whys if you'd like.
Let's get to that. Why exactly?
To start off, if you think about what I might want to leave you with today, there's two conclusions. One, and I am burdened by math, okay? So this is just math, but fossil fuels are going to be around for a long, long, long time. And in a presentation I gave to a group of investors a while ago, it was titled, We Need It All. And you tie that to there is no silver bullet. the second conclusion is there's a duration mismatch. And by that, now I'm talking as a, there's renting stocks, there's owning stocks. As an owner, you think about the market is going to continue to price the sector as though demand is going to collapse because that's what they're being told in the media every day. And for that reason, risk adjusted, it's probably not a bad place to invest as long as you can stomach the volatility. And so back in 2017, I had this insight and I thought I was super smart. And then I realized that I'm super dumb because I was 150 years late on the insight. And the insight I had was that technology and efficiency in energy tend to increase demand. And a guy called Jevons, it's called Jevons paradox, long time ago, figured that out with regard to coal demand. And if you think about how things have evolved, start with the wheel, right? What did the wheel do? The guy who's responsible for climate change is the guy who invented the wheel, if you think about it, right? So that alone is driving massive change in demand. And so when you think about fossil fuel demand, you've got, if you go back to, say, 2000, right? Total fossil fuel demand for the world is up 45% relative to all fuels as a total up 52%. And I don't want to get too many numbers going here, but if you think about Europe, because they're kind of the leader in reducing use of fossil fuels, their fossil fuel demand over the same time is down about 19%. So they are sliding away. And that's led by coal generally, although Germany's up and whatnot. But here's the context. It's the big but. Demand in Asia is up 130% over the same time period, but that's 10 times the absolute European reduction. And that's because that's where all the people are. And, per capita Asian energy demand is notionally a quarter of what North America is. Per capita Asian demand keeps lifting. It's notionally doubled since 2000. So you can apply crazier metrics to Africa, places like that where per capita demand is ridiculously low, but, starting to ramp up. And so the context I would give you is if the developed world drops per capita demand 40% and the developing lifts by 80% so that we're the same per capita, global energy demand goes up 35%. So how are we going to meet that if that's a thing? And it puts enormous stress on the systems because since notionally 2000, renewables have not met just the growth in demand. And so when I say there's a duration mismatch as an investor, and that's what does this mean, right? Like you just gave a bunch of numbers. What does it mean? It means I can invest at reasonable multiples and expect a reasonable return. And I kind of like that. It's a little bit of color on this article. Like one of the other things, and I feel like I hate the word narrative because it implies storytelling and fibs, right? But if you think about fundamentals, there are fundamental things that make energy demand real and encased in our culture and our behaviors. And I'll use Canada as an example for climate change. I got 3 kids. They're in hockey. We notionally drive 10,000 kilometers a year. The first rink in Canada, indoor rink, was, illuminated with natural gas. There's, 2,500-ish, 2,800 indoor rinks in Canada. Without low cost and reliable energy, none of that would happen. But that is part of the Canadian culture. And you're not going to get away with it. And, one of the other things that I sort of allude to in the article is a little bit, and I'm careful how you phrase this, but the cost of human labor, right? So like if you go back through 5,000 years of human history, every successful empire has been built on slavery. And it kind of went away in, 1865. Okay. That was when the US abolished it, at least for that segment, but all the other empires of the world have used it throughout history. And then suddenly we did away with it. Well, the 1850s and 60s, through 1700s, you had coal coming up. You had Titusville oil discovery in 1859. And if you do it in today's dollars, at $15 an hour, 1 liter of gasoline can do the work that would cost $2,000. And that's not necessarily my thought. Like I don't think that's a new thought that I didn't come up with that thought, but I've done my own math to suss it out. It is illustrative of our modern day lives are so intertwined with fossil fuels and relying on it, such that I think Vaclav Smil had an estimate that fossil fuels provide 200 slaves for each and every North American. Mm-hmm. It's context.
He's a good writer.
He is a good writer, and it's just really does drive home, duration once again.
That's the backdrop for that article and the idea that I guess ultimately energy demand is rising, which trickles down into investing in the sense that it may be a good sector to be looking at. But one question I had for you, or I guess one question investors would have for you, is how do you translate that into returns and results? Some of the criticism in the sector lately has been that the returns aren't coming, the re-rates aren't coming. The last couple of days, the stock's been getting hammered. What are your thoughts on that? Does it just take time, or to bring it back into a practical application?
Yeah, I think it's a really fair question, and because we're tight on, if you argue that we've been under investing for a while,
exactly,
we're sort of on the knife edge on supply versus demand a little bit. And, is there a recession, and does that really impact commodity prices? And so the volatility is real. And I think as an investor, you really want to carefully, if you choose to invest in the sector at all, and you might not, you really want to be careful on who you sidle up against as regards to strategy and capital allocation. And there are some examples recently, and I don't want to name company names specifically, but there's been some real challenges, and I think there's some pretty valid questions on capital allocation and things like that, and sustainability of things like dividends, right? Like dividends are an output of a good business. They are not an input for valuation. And I really, really think that people get confused on that. Right? And it's a 5% yield. Well, is that good or bad? I have no idea. Look at the business. I don't even care. It's not a relevant component of pricing a stock, because dividends can be set by a board incorrectly. They don't always get it right. And so why would you use it for valuing a stock? I have no idea. It's more about, strategy, capital allocation, and making sure that you are driving a return there such that, year over year, generally, cycle aside, you've got more per share afterward, if that makes sense.
The backdrop is, like we said, that demand's increasing rather than falling in terms of overall energy and fossil fuels, which sets up, you could argue, good conditions for the investor in the sector. But the trick is to pick your winners, I suppose, is one way to phrase it.
Yeah. And I mean, look, oil executives, and I say this with great humor, most parents, I saw some article that said like 80 or 90% of parents think their kids are above average. So most executives will tell you, because that's, their companies are their kids, right? They'll tell you that their assets are top quartile. And I don't think they're lying. I think that there's pockets of greatness in most companies. And how do you define great anyway? Is it asset life? Is it per well economics? Is it repeatability? Like, there's so many measures that you could use to say we're top quartile, right? And so that's up for an investor to determine. But if you wander around, you can, if you just get familiar with the sector, you can probably start to figure out who you want to bet with over the long term and who's just a renter, and that's okay.
Mm-hmm. The other fear from investors is, like we were saying, is that demand's going to fall off a cliff, although it's not. And you can support that with data. Do you think that it just takes a matter of time before that information is dispersed, in the sense that people understand fossil fuel demand is not going away? Or do you think it matters? Does it just take time?
You know what it does is it, and we can talk a little bit about a case study. I call it there's a couple mini case studies we could do on different countries. Mm. But, I think board members are cognizant of this on capital allocation, and that's why the sector is under investing. Like, notionally CapEx to cash flow looking into 2024 in Canada and the US is probably 46 to 50% ish on a group of companies I might look at. The fear is always out there that some great technology or we can talk a little bit about electric vehicles if you want, but it's going to have a massive impact on demand. But I look at this stuff too, and I wonder and I worry, right? Like how real is all this sort of stuff, and should I be concerned, and where should I be allocating my own personal capital? And I'll give you an example. So I did a case study on Norway. It's a tiny country, right? Yeah, produce a couple million barrels a day. The reason Norway is interesting is because it's a small country and they only use about 28% fossil fuels. And the reason is, and this is part of, the different countries are going to transition or have the ability to transition in different ways in different times. And there's a handful of countries that have small fossil fuel demand relative to the total because of hydro. And, if you really think about Norway, it's interesting because their sales of electric vehicles, like they've been 90-ish% of their sales, their car sales are electric vehicles for the last year or two, right? And so they're kind of at the leading edge. And yet, why did they do that? And then what's happened? And so they were 3% in 2012. Now they're notionally 90%. Gasoline use is off since 2013. Okay. Like 35, 40%, whatever the number is. But Norway is a wealthy country. And so rich people buy vacations and they're buying stuff on Amazon. They're expanding their industrial sectors. So yeah, gasoline demand is down, but diesel use is up every year since the 80s, including a record in 2022. And jet fuel demand, there's pre-COVID, post-COVID numbers, but notionally it's between 50 and 100% up. And so then when you look at aggregate use of oil, it's down a little, but not a lot. And so the other thing that you could argue is when you model electric vehicle adoption and pacing, it's actually just like modeling an oil field. So I've done it. The car park is enormous globally, and these cars have lives. And so if I go sell my truck, it may go through a couple of other users. I go buy an EV, but my truck is still running, and it may end up in a developing country and being driven for many, many, many more years, possibly with a worse filter on the engine or whatever. And so it's going to take a long time to really, really have a huge dent on base demand. But I find stuff like that fascinating, right? Because you want to look at, you need a little perspective as to pace of transition and how that could actually occur. And there's different countries we can talk about if you want, because I think it does, there's illustrative outcomes for investors. Again, do I want to own this space? And is there really a duration mismatch, which is a key question to ask, in my view.
That's the question I guess maybe the investor on the street would be wondering, is that does the question we just asked translate into returns, and when are my stocks going to go up, I guess, basically in real simple terms? Well,
I think the Ponzi scheme, we talked about this last time, but the decade-long shale oil Ponzi scheme is over. 2021 and 2022 returns are pretty good. This has been a little tougher year, certainly, and I'm seeing some differential stock selection. You can see it in the multiples where investors are starting to pick their horses and afford them a cost of capital. And you're starting to see M&A come out of that a little bit. And that's I think that's a healthy outcome for sure. But you're not going to beat going negative 40 to notionally $80 to $100 oil, right? Like that's a real thing. And it's a bit more steady state today. But if you think about the discipline of the sector, and again, these are a group of companies I might look at, and I gave you the same math last year. I went and looked at it again of a group of companies I might look at when I think about how much they aren't spending but they are spending on buybacks and dividends. There's 2 to 3 million BOEs a day in North America that are never showing up per year. And so we're not growing like stink, although this year in the US has been pretty good, but we're not growing nearly to the pace we could if everyone had just kept all their capital in-house. And so what that does is it helps limit a little bit cost inflation a little bit. And it helps on the commodity side so that you don't have as much downside risk when a recession or whatever does hit. Because the next recession is always around the corner, right? Mm-hmm. So that feels a lot healthier to me.
Or OPEC decision that erased the margin.
Yeah, that's right. Like the balance sheets, I mean, the sector is probably as healthy as I've ever seen it. You've got balance sheets at notionally half a turn. The valuations, looking into 2024 don't look stretched to me. There's some bifurcation on have versus have not companies, which is a healthy and expected evolution, but it's taken some time to come to fruition. And that's fairly reasonable to me.
Do you think the energy companies are currently fairly valued or still undervalued?
Well, I think if you do, I can't remember if we talked about this last year or not, but I have a valuation model that the valuation model that I would run suggests that most companies are undervalued. The multiples, I think, have lifted a little bit. Pick your commodity price because you try and run what you think is a mid-cycle price before you say things like that. And some companies, I think some companies are looking a little worse, frankly, and some are looking a little better. But the model does suggest that things are reasonable in terms of risk relative to potential return, and that's okay. But I think, the stock selection is starting to matter more for sure.
The critical investor would say, if your stock's undervalued, why are you issuing equity to do deals? What would your response be to that?
It can also be a relative cost of capital argument, right? So if you're trading at 5 or 6 times EV to EBITDA or however you want to measure it, and you're buying something that's for 2.5.
Yeah.
And I think in certain instances it's really reasonable to think about the ability of a given entity, the buying entity, to bring costs in. Again, I don't want to name companies or anything, but I think that there's some fairly legitimate rationale for that. In other instances, I might be more doubtful that that's going to come. And I think every investor has to apply put his skepticism hat on and say, well, do I really think that this is genuine? And in some cases, I think it is. And some, I don't know.
And it just takes time, I suppose, for quality management teams to prove themselves.
Yeah. And I think size matters, like relative size of a deal matters a lot because of integration risk and actually knowing what you own, in the sense that you're picking up a lot of wellbores, you're picking up a lot of, in some instances, ARO, abandonment liability. Has your technical team truly costed out in the right way the cost savings that they think they can get on a risk basis? And every business has to take some risk to make money. So they're not just doing this willy-nilly, right? Like everybody thinks it through. It's just some are probably a little stronger at it than others. And then sometimes everybody's terrible at it, or everyone's great at it for a while. Commodity timing can sometimes prove you very right or very wrong. Even the best M&A done at the wrong time in the cycle can be pretty hard on you, right?
To what degree do you think the investor sophistication plays into that kind of knee-jerk reaction on deal day? Is it a big factor when they see equity issued, they just hit sell, or do you think it just depends? Or is there a deep knowledge of some of these deals that goes on?
I would say no, there isn't deep knowledge of some of these deals generally, just in the sense that most portfolio managers tend to be generalists these days. There are a handful of really sophisticated investors on the oil and gas side that remain. But, it doesn't mean that generalists are dumb either. There's some really clever ones out there that are absolutely know the space, and they know what they want to look for in terms of these deals. And sometimes it's having a relationship with the management team and saying, I'm going to hold you to this, right? And so I don't think they just blow out the stock because the guy did a deal. I don't think that that's responsible capital management. I don't see them doing that necessarily. Sometimes they might, but other times they're in a more extreme scenario that I guess that could absolutely happen, but they're pretty thoughtful people.
Do you think a roll-up strategy is the right way to go? Certain entities out there are maybe going down that path. Does it depend, or do you think you should just focus on what you own?
Well, I think there's different levers you can pull within the oil and gas business. And you do have to remember it's a declining, the air is coming out of the balloon every day. Yeah. And so part one of it would be land acquisition, and on a risk basis, can the technical team add risk locations? And if you're growing, if you think about it, if you're growing, every well you drill has to be replaced by more than one location, because there's risk on the location, but you're also growing. And that's presuming that the location, the newer locations are as productive as the old ones. So maybe a rule of thumb is if you're growing at 3 to 5%, you need, for every well you drill, you need to replace your inventory with 1.2 locations or something. I haven't really done that math because I'm not sure how truly accurate it would be, but that feels like a gut number that's not unreasonable. And so that's part one, but it's hard to get land in scale on active plays that's cheap. And there's that battle. And also, can you put your arms around enough land to make it worthwhile? In other words, can I create a productive capital business that is scale enough to matter? And then you dial into, should I be doing M&A or not? And that is absolutely a valid part of strategy. And it's especially if you feel like you have a competitive advantage technically, you have a cost of capital advantage, or you have a cost advantage in terms of execution. Those are very legitimate things. I do wonder sometimes at the very large M&A deals, just because the risk becomes so much higher on integration. But for smaller deals, and I have my personal rules of thumb as to how big a deal should be for a given company, you really do think about size and integration and stress on the team and things like that when you're doing M&A, for sure. It's a big question. And that's the stuff that investors don't necessarily get to see as much of.
Yeah.
But it's real.
I guess the critic would say you should be focusing on what you own now, and the best management teams seem to organically grow through the drill bit on what they own now. Maybe there's a time for M&A, the right time in the cycle, but you're an oil and gas company. The point is to find oil and gas now on your property. Is there that factor that kind of weighs into decisions, or I guess it just depends?
Sometimes it's like, if you think on a full cycle basis, sometimes the stock market creates M&A opportunity. In other words, if I have $1 of capital to allocate, right, and I can put it into full cycle new land and drilling, or I can buy something tomorrow, sometimes it's actually cheaper to buy the barrels on Bay Street than it is to drill them.
For sure.
And, that would tie into things like strategy, looking forward a lot, and all those other elements I mentioned. But I think it is a valid way to add value to your company. It's just size, strategy, timing in the cycle, cost management, integration. Like, there's a laundry list of things that really do come to fruition when you're thinking about M&A, and it's fraught with risk, and it's very hard. But sometimes it's amazing wins.
Demand is clearly rising, but the other part of that is the supply crunch, where companies haven't been investing in production. It's been kind of flat and harvesting cash. Yeah. Are you still seeing that trend in the industry as we head into 2024?
Yeah. So I mentioned it a little earlier, but we can talk to it in a bit more detail. But the universe of companies that I might look at are spending, I think, 45 to 50% of cash flow. The supply side, I mean, there's various different research houses that have pointed out that the Permian productivity per well is falling, and Permian is an amazing place. There's lots of resource there, but because the capital discipline is there, and if you really just go back, like if you look big picture, maybe since 2010, say, effectively 100%, and I'll be off a little bit, but effectively 100% of the oil production growth has come out of North America. And I forget the gas statistic, but it's a ton. And so where is the new supply going to come from? And I know OPEC does have spare capacity, and the best estimates I can find suggest it's 3 to 4 million barrels a day. And these sorts of things. You also got to be mindful that globally we probably have 6 million barrels a day of decline every year. That's a pretty big hole to fill, right? And so I feel like that will drive if you want to say you're on a little bit of a knife edge, and the knife edge is, supply versus demand, and are we going into a recession, or are things ripping, and all those sorts of things. But that volatility creates plenty of opportunity. And I mean, you look at the oil price in the last year, how many 10 to 15% drawdowns have we had? Like 12 or like, I don't even know. I mean, it feels like every few months you get this big gut punch and oil collapses. That volatility, it's very tradable. As a company, it makes it a little harder because you're trying to put together budgets and things like that and returns, figure out what your returns are. And it's all over the road. I mean, open them all every once a month, and the numbers have all changed again. Right. So, but I don't know that there's going to be, you see supply come out of the US, there's Guyana, clearly Russia, and all of the sanctions. I mean, you knew the sanctions weren't going to work because they historically never work. And the Russians are masters at black market. I don't know why anyone thought it was going to shut in Russian volume. And Brazilian supply and things like that have actually been okay, right? So I don't see tons and tons of new supply coming either.
In terms of resource, some would say the Permian is the largest oil resource in North America. When you compare that to, say, the Montney, do you have a place you're looking? Do you have a basin that perks your interest?
Well, I mean, I think my PA is biased to the Montney for sure. Probably because I know it better, though. I guess I'd be biased to Canada because I'm most familiar with it, and it's just driven solely by economics, right? So there's the scale, repeatability, and then what's the commercial outcomes on the wells, right?
And that's pointing towards the Montney.
The Montney has a lot of scale, and I'm not promoting any of the companies I'm involved in today, but the Clearwater is a pretty interesting reservoir as well in terms of expanding scope and the economic returns of it.
Sometimes it's not easy, but it's not hard to identify the chessboard in terms of resource. How do you get it out, and how do you create value for people? What to you makes a good, is it culture within the team? Is it good capital allocation? Is it good geologists? Is there a combination you look towards when you're looking at extraction?
I start with strategy, because I feel like a lot of oil and gas companies don't necessarily have a strategy that's super clear, at least to me. And
the secret sauce.
Yeah, I don't know that, I feel like one of the things that I always say to the people I'm working with is, if we're building something someone else wants to own, whether it's an investor or another company, how are we going to do it? And if we're going to do something, are you more likely to phone your mom and tell her to buy the stock if we do this deal or not? And if the answer is or not, then you should really take a gut check as to whether we're doing this, because that's a different way of phrasing short-term versus long-term thoughts. And so if you're pushing for quarterly results and things like that versus annual or multi-year results, you're going to have some different outcomes. And I think the team really matters. Cost management really, really matters in this business, and you have to be vicious about it almost. And that ties into strategy and your execution on the drilling front and things like that. So there's a lot of elements to it, right? And it's very easy to get wrong. I'm wrong every day. Just ask my lovely wife, You got a laundry list.
The idea is that IP is fairly limited in oil and gas, so that there are maybe proprietary reservoir analysis, but that information is dispersed really quickly, and that the secret sauce is really in the team and how they work together, and maybe it's not talked about as much. Do you view it that way? Yeah.
So back at Peters, I sort of would have developed a rule of thumb, or we had a rule of thumb or whatever. I don't think it was just me on my own, but when new technologies come to fruition in the oil business, at best you've got 2 years. All it takes is one guy at a service company who came up with some neat idea to quit and go work at a competitor, and he just recreates the idea in a different way at the competitor. It happens very, very quickly. And so, whenever people used to come in and say, we've got this great technology, and try and pitch us on some financing of it, you just got to be very, very mindful of how fast they can get market share. And so, yeah, no, but there are really neat, it actually ties to deflation, right? some of the technologies that guys have come up with, whether it's horizontal drilling or, some of the way fracking is going on and sourcing water and then some of these new multi-leg wells that are being drilled in various reservoirs now. And it's really neat to watch and observe and be involved in. But to say that it's truly proprietary, I'd say no. But boy, does having the right team on the capital management side matter? That's a fair point.
As an investor, do you have a checklist on what you go down in terms of importance? Number one might be management. Number two might be rock. Number three might be the commodity cycle. Do you have a sort of list that you?
Actually, it's a pretty good list. Yeah, I would say the team is 80 to 90% of the call. Mm-hmm. Yeah. Like, you mean for like a new startup kind of a thing, or just like in general?
In general.
Yeah, I guess it doesn't really matter. I think that people are 80 to 90% of it. Yeah. Yeah. I mean, great management can't fix terrible rock, but great management tend not to get involved in those plays. I think there's some larger companies in the city that have proven that out over the years, right? As well as startups. The management really matters. And it's also, one thing that you haven't mentioned, by the way, is capital market savvy. That is a huge component of how you message things, how you work with the markets, how you respect your investors, how you treat your stock, because it is a currency. At the end of the day, you want as few shares outstanding for every barrel. However the end looks, the less shares outstanding, the better. So then how are we going to act and phrase that such that that is the outcome? And that's a component we haven't talked about yet.
What is an example for the listener of poor capital markets strategy or communication or process? If you were to, is there one red flag that comes up for you for the listener?
You know what it really is? Having a currency, and we can actually tie this to the Western democratic governments, by the way. It is a privilege to have a currency with value. And I feel like not respecting that privilege is the downfall of, and I've seen it over and over and over again throughout my career. And it's not being mindful of that. And I guess a real high level example would be, let's say I've got a company that I'm running and it's trading at 7 times. And then I just go around issuing paper to buy everything that's trading at 3.5 times. And the reason it ties to countries and their currencies is because it's inflation, in the sense that over time I have to find the marginal buyer for my stock. So all else equal, my multiple has to fall, and it'll fall to the multiple of what I'm buying, because that's what I'm buying it at. And so then I have to issue more stock for the next acquisition. So I've created inflation. In other words, I've devalued my currency. And that is easily the biggest mistake I see companies make on the capital market side, is not respecting their currency.
As a person on the investor side, or kind of in a position of influence right now, do you have to sometimes subtly suggest that, no, you should save up for that deal? You can't afford this deal. Is there ever a tension there where maybe you have to say, wait till you can pay cash?
One of the jobs as a director is to push back. And yeah, I mean, I can't obviously speak to specifics, but I am an opinionated guy, and I'm not always right by any stretch. But if I have that sort of a situation, I would absolutely make it clear in whether it's, is it too big? Is it not the right time? Is it this? Is it that? Is it the right deal for our team? There's a whole bunch of reasons why you might push back on an acquisition. And it's because they don't always work out and they're always risky. And so how do you size it properly? How do you think about the capital? And then how do you think about the costs relative to the returns, and, hedging? Like, there's all sorts of things that need to be thought about. But yeah, pushing back is part of a director's role. Sometimes you do have to do that. It's part of strategy.
You can't afford this, so to speak.
Yeah, in a way, I guess. Yeah, that would be fair. And it's a can't afford it relative to the risk. And so maybe there's 10 risks or maybe you can't afford it if you're going to issue a bunch of paper, but how are you going to get overwhelmed by the risks, especially if there's a downturn?
Yeah.
What happens to your balance sheet?
Yeah. Sometimes the problem is that advice comes with a fee, or biased advice comes with an incentive from the other side, and that people aren't always making clear decisions.
Yes.
Again, do you have to weigh in and say, listen, the advice that you're receiving may have a bias and a fee associated with it? Is that important in corporate strategy?
Absolutely. And I really do have friends in the investment banking world. So I say this with great love and respect, but they are acting because they are running a business. And so they are in the business of executing and making money. And so that bias always has to be taken into account. And that's okay, because that's your job as a manager and a board and a company, is to say, well, okay, let's carve through the bias and is this actually making sense, right? And, you know, sometimes it's easy to see through it and sometimes it's not, but.
Maybe you can wrap up with inflation. Which angle did you want to go at it?
Here, let's use a Dickens quote, right? Like, and it gets overused, but it's the best of times, worst of times quote. And if you think about it, it's kind of the best time ever to be alive. Like, you and I can turn on our phones and there's any number of Uber drivers who will treat us like kings and transport us to a restaurant with any kind of cuisine we want. And, you know, there's all sorts of other marvelous examples of the world and life, right? But, you know, we've got war, we've got climate change, we've got biodiversity risks, we've got energy security problems, we've got food security problems, and it's a very challenging time. And, you know, as an investor, you remember things like that, and you also think about inflation as well, because I feel sometimes, and I know inflation has been trending down. I think we talked about that last year. It looked like it had peaked a little bit, but I'm more on the secular inflation long-term page.
How can it not be?
Look, let's go through the list. I'll read you my little mini inflation things to think about list. And a lot of them, if you go back 10 years, weren't really there before. So cyber, right? Cyber risk, cyber management, paying all these fees. You've got war. Every bullet you shoot is wasted resource funded by governments in the sense that the resource is gone. You do have climate change, right? You know, I looked up Alberta and BC forest fires this year is $3 billion between the two provinces. I think in the energy transition is the biggest undertaking in history, on the industrial side. And there's hilarious articles coming out on the grid and the rebuild, right? Like, what did the IEA say? 80 million kilometers of grid, which is 2,000 laps around the earth, need to be built by 2040. It's like, that's not happening. It's like, that's just insane. And you think about, there's a great article in the Wall Street Journal where, you know, Koppers, which is a US based company, and they help, you know, utilities build out things. One of the things they provide is poles for electrical transmission. And they have one plant that puts out 350 trees a day, but the thousands and thousands of these things, and they're flying helicopters in to pick off certain trees. Like, you're going to run out of trees that are tall enough to be electrical poles. So then you have to use other materials. Like, it just goes on and on and on. And, you know, a lot of the US grid in particular needs rebuilding because the useful lives are 40, 50, 60 years old. The next item on the list, frankly, is the opioid crisis. That wasn't there 10 years ago. And you've got health, police, fire. You know, the CDC in 2020 said it was a $1.5 trillion cost. Okay. And forget about the social impacts, because that's not the purpose of this call, because it's a horrible thing. But that's money that could be spent doing other things that are productive. You think about wind and solar. And when I say we do need it all, I really do believe it. But there's been a shift on the cost understanding. And I knew this years ago, but it's amazing. So back in 2017, it was the first time I saw it. There was an investment bank called Lazard, and they started publishing levelized cost of energy. And what they did was they were showing that wind and solar were materially cheaper than all other forms of electricity. And the phrasing I would give the oil and gas community is really simple. We figured it out years ago. And then this half cycle or this levelized cost of energy concept, I thought it was ridiculous, but it sort of became the norm way of talking about and calculating returns on wind and solar projects. But the parallel is half cycle economics that the oil and gas business ran in, for the Ponzi scheme decade in North America for the shale. And so half cycle economics just means if I drill one well, what are my returns? And if you see a company with 20% half cycle returns on a well, you should short the stock because there's all the other costs. There's land and infrastructure and transport, right? Well, levelized cost of energy that Lazard was doing was not including backup because it's an intermittent source. So you need batteries or you need gas fired, and you also need transmission. And so these costs are real. And by the way, countries like China control a lot of the materials in manufacturing. And so I just feel like that understanding, and then you're seeing the wind and solar companies, they've been imploding recently. Like Siemens had their big write down and they got a bailout from the government. And okay, so government bailout, how is that not inflationary, right? Because you're printing money, unless you're cutting entitlements elsewhere, you're printing money to bail out something that isn't working. And you saw Ørsted, they're down notionally 70% or whatever the number is from their peak because of cost overruns, interest rate delays. Remember last year we talked about the oil sands in 2008 were 100% over budget because everyone was doing everything at the same time. We talked about this, like everyone's doing this at the same time. So then the costs have to be higher because there's only so much stuff to go around. And so that creates inflation. And then you have deglobalization, right? The reshoring of manufacturing because we're not friends with anybody anymore. And then you're starting to see strikes all over the place as, the boomers are retiring and, suddenly there's a shortage of workers and you've seen the auto companies, the actors, the St. Lawrence Seaway, Quebec, the healthcare system and the teachers all just went on strike this week. Like that doesn't help. And then you have the ultimate problem with inflation is the incentives for our governments are all wrong. And by that, I mean, and I say this really gently, like I think politicians go to work every day, just like you or I do, and try to do the best they can, but they're incented to make decisions that get them reelected rather than make decisions that make the country better. And I have lots of ways we should change those incentives. We don't have to get into that today, but unless you're cutting entitlements, you have to print money to do it. Can I give you my Canada shocking number? The Canadian currency started 165 years ago. And during the COVID 3 years from when, Feb 2020 to when the WHO said it was no longer a pandemic, we printed 35% of our currency outstanding. So in 1.8% of its existence, we printed 35% of the currency. And I'm not saying I would have done anything different if I was in the government at the time, but to not acknowledge that is an inflationary outcome. And we keep doing it. Like we've got the dental, we've got pharma, we've got free heat pumps going out to the East Coast. And the providers of those services have no incentives to cut costs. So why is this anything other than inflationary? The main offset that I can see is just technology. Yeah. Is a decent offset, and I'm seeing all sorts of really neat technologies that are helping bring costs in. So it'll be a bit of a battle, but it wouldn't surprise me at all if we're in a bit of a secular inflation for quite a while.
And to bring it back, how does that impact the energy sector? Increased demand?
Well, as an investor, I want to own real stuff, whatever that might be. Whether it's insurance stocks, as an example, it can be, owning commodities. It can be owning companies that produce commodities. There's a bunch of different ways to play it. And I think what the companies themselves will be working on constantly is bringing in costs through finding efficiencies. And I'm seeing, that technology impact is probably like I missed the AI boom because I'm not a tech guy, right? I wish I owned it, NVIDIA or whatever, but I don't. But I am seeing second derivative interesting things in the energy space. And that's a real and growing probably theme over the next 3 to 5 years, which will help. And there will be some leaders and some things won't work at all. They'll be tried and failed, but other ones will work wonders to bring costs in, right? So I find that stuff fascinating. I don't know how material it'll be, but we'll have to see.
Well, that's an hour. We've covered a bit of energy supply demand, some of the current events, some of the topics like inflation, investing, although it's not advice, some thoughts. I think the audience will really appreciate your thoughts. So thank you very much.
Well, thanks a lot. It was good to see you and happy to do it.
Alrighty. Thank you very much.
Thanks.
Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.